Hey everybody, this is Kevin with Leading Edge Financial Planning. Today we're going to talk about Q2 2019, just ended. And as always, we like to give you messages about investing. We feel like that's the most important part. One of the questions that we were asked in the survey was, why don't we get out of the market before it goes down? Or why don't we get out of the market when it's going down? And so I'm going to try to answer that question today. But quickly, I'll just say that that's timing the market. If you do get out, what happens if the market goes right back up again, right when you sell? When do you get back in? What if the market continues to go up? Then do you try to get back in at that time? What if the market continues down? How long do you wait to get back in? It's something we would love to do, and if it worked, we would absolutely be for it, but the academic evidence suggests that you have to be right more than 70% of the time, not just in the sale, but also getting back into the market. And that's what makes it so challenging. So the first message is markets can't keep going up. Well, I don't know if that's true. I don't know that it's not true. So what we've seen recently is we see the market keeps hitting all-time high, all-time high, all-time high. And people keep saying it can't keep going up. It can't keep going up. Well, if you look back on history, the market's been at an all-time high, I don't know, I want to say hundreds of times, maybe even 1,000 times in my lifetime. Every time the market gets to a new all-time high, people will say, well, it can't go higher, and it could. And that's the reason why we believe in humility investing, is you really don't know the future. Okay, if continued earnings keep coming out and things keep being good, the market can keep going up. Now it can't go up 90% per year. I doubt that could ever happen, but again, trying to time the market high is very challenging. So I talked already about why not sell when the market is down. I'll come back to that. And then what is your time period for investing? If you get one message out of this video, it's to understand what your time period is, and that really frees you up to not worry about the vicissitudes and the craziness of market fluctuations. Because really, moments in time, when markets go down, that's more moments in time, I would suggest. And if you're investing for the long term, I'll show you at the end the percentage of times that markets are positive in a given year. So you will experience moments in time. You will experience misery if you're an investor who pays attention. I wish it was easier than this, but that's many times why people have an investment advisor, to keep them disciplined when markets get crazy. And this whole idea of short-termism is something that's going crazy in our world, and something that we're trying to push back on. When we look at what the returns were in Q2, again, this is short-term, okay? It was another good quarter. The thing we can learn from this is, after 2018, which was a terrible year, it felt real bad. Everybody was pessimistic. So far in 2019, things have been great. US 4%, developed almost 4%, emerging markets less than 1%, global real estate was up, and then the bond market had a great quarter, really great quarter. You can see the average quarterly returns of these investments. And of course, they are all over the place. They're not usually close to the average, but these were the average quarterly returns, and that's what happened in 2019. The second thing that's extremely interesting to me is that the world has continued to lag. Now, the question that sometimes comes up is, should we invest in the world? And modern portfolio theory, efficient markets, suggests eventually that prices in the U.S., if people love the U.S., will get so high that there will be value in the rest of the world. Eventually, if everyone keeps bidding up the prices in the U.S., eventually the world will become more of a value play. You'll be buying things on discount. I don't know when that will happen. And then global real estate, once again, has had great returns over, even in the decades. I mean, just great returns over the last decade, I should say. U.S. bond markets up almost 8% over the last year. Really, really tremendous. Okay, so here's the short term. Now let's pull back here, and let's look at this chart in the upper right here. Okay, so this is the last year. This is still short-termism. But we see here, like I said, in December 24th of 2018 was a very miserable day. Market had been down about 19% from peak to trough. It's come roaring back. We had another little time where it looked like things were going to get bad. But when we look out over the last 19 years, here's the last 19 years. We have all these news stories happening every day, every other day for the last 19 years. If you were a prudent investor and you're an accumulator who just kept buying during this whole time period, you've gotten fantastic returns. You've earned those market returns that we talked about. If you got in and out and you got out at a bad time, you may have missed these tremendous returns. The different asset classes, you can pause the video here and take a peek. The S&P 500 continues on a tear. Will it last forever? I doubt it. I think some of these other indexes, there's more than one index, by the way. There's many different indexes, different countries, real estate, bonds, etc. The only thing that was negative was the small cap index in the emerging markets. So U.S. stocks, U.S. large growth, large cap in general did very well. Large cap value, the companies that you buy on a discount did a little bit worse. And then you can see that small across the board did not have a good quarter. By the way, 55% of all the world's investment that's in public markets is now in the U.S. market. 34% is in the developed market, so developed part of the world. Growth did very well. Large cap did pretty well. And this is just real quick, if you want to know about currency, this is local currency, U.S. currency. Currency helped us. The currency differential helped us this quarter. Emerging markets makes up 12% of all the investable universe. Hopefully these countries will start to develop and investments will do better. The 10-year investments in emerging markets has probably been the lowest it's been over a 10-year period in my lifetime. I don't know if that's accurate. Someone can tell me I'm wrong, but 6%, and you would think with the risk of emerging markets, they would have higher returns. Probably will return to glory again someday, but this quarter was not the quarter when it happened. If I told you Greece was going to be the #1 country in the quarter, would you have chosen it? 23%. That's about 100%, a little less than 100% annualized return. And then Switzerland, Germany, Australia, Singapore, and France all had tremendous quarters. And then Hong Kong was the laggard. Japan and the UK. The US is over here, kind of in the middle of the pack. Currency, we've already talked about. So real estate investment trusts, investing in real estate. You can invest in worldwide real estate. That's how we invest with REITs. You have US makes up 58% of the marketplace. The world ex-US makes up 42% of the REIT marketplace. And this time around, this quarter, the worldwide REITs did better. This year so far, they're coming in pretty neck and neck with global just underperforming U.S. REITs. Won't get into commodities. This is what we call the inverted yield curve. You put your money in a 1-year bond, you get a higher return than a few-year bond. That's all I have to say about it. Not much. Okay, the impact of diversification. If you want higher returns, and you're willing to ride this roller coaster, this is since 1988, you're willing to ride this roller coaster, you will probably get higher returns. And I say probably because what happens if you retire here? Or what happens if you die here? Just saying that 100% stock is always going to be the best for someone. If you're right here in 2013 and you need the money and you grind along, and then you retire, you might wish that you were in a different asset class. So I think the key thing for clients to understand is how much risk are they willing to take. It's our job then to initiate your portfolio to match not only your risk, but also what you need to live the life you want to live. But you can see that 100% returns, especially after a tear in the market, has done well. 75% equity still has done well. Okay, so we talked before about averages, and the interesting thing about stocks is it looks like a shotgun blast here, is that this is the average. 10% is the average stock market return. This is going back to 1926, but when you look at any given year, it's many times well above or well below what the average is, and this is the reason why discipline If you can just get 10% returns, if you could get 10% returns every year, your money would double in 7.2 years. If you get out because you fear these bad times, or you take too much risk and you have to get out, well, that's when it really hurts. And so this is what I was talking about, like getting out of the market, selling in a downturn. All right, so the market's starting to go down. Why don't we sell? Well, in 10-year periods, S&P 500 is positive 94.7% of the time. So any dollars that are in the stock market, you should have a thought process that you're not going to spend the money for 10 years. Pretty good chance that you are going to have a positive return. Again, future, we can't guarantee that's going to happen, but we have to use some probabilistic thinking here. Over 5-year periods, 87.7% of the time, the market is positive. If you have a bad year where things are looking bad and you get out, you might miss the next positive year. That's the hard part about investing. That's the discipline that we try to bring. And then every year, it's a 75% chance, at least based on this time period, that the markets are positive. So anyway, we appreciate you watching. Thanks so much. If you have any questions or comments, please let us know. Please like the video. Thank you so much. Have a great summer. Bye.